Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. PITI, P-I-T-I. It's the first acronym I ever learned in real estate when my dad explained to me as a young boy what makes America so great, how homeownership is larger here on an individual basis in America than anywhere else in the country. And it's because of PITI, principal, interest, taxes, and insurance. It's a calculation that comes into effect when approving us for mortgages. It's how the entire mortgage industry has set up to determine whether you and I have the ability to repay our mortgage and get qualified for a loan. It's principal, interest, taxes, and insurance. And the pity of it all, and what we're about to hear today, what we're going to talk about for a few minutes today, is that for a long period of time, mortgage lenders, borrowers, banks, there was really only one thing that concerned them, and that's principal and interest. Because for decades in this country, taxes and insurance have been a relatively stagnant data figure. It had been the numbers that you kind of tacked on to your principal and interest payment as a way to figure out what the total payment for each month would be. But taxes, usually based on 1 to 2% of the property value, and if you're homesteaded, that value is capped on income. They've been pretty predictable over the years. However, in recent years, states like Florida, where there's no state income tax, and the only way one of the major ways that they direct revenue into the state is through property taxes. Those property tax increases above 2% of the assessed value of properties have skyrocketed. And do I have to say anything about insurance? Florida may be a perfect storm example of the problem that exists in property insurance here in America, but this is not a problem that is just limited to Florida. This is a nationwide problem. It's not even a problem that's limited to just Florida, the Gulf Coast for hurricanes, maybe a couple Midwest states, and California for fires. It is now a nationwide problem. For the first time in the last few years, we've seen major hurricanes hitting the middle of the country, like the Carolinas. We've seen tornado and wind events in the Midwest all across America, causing billion-dollar weather events, not just once a quarter, but once a week. And those kind of insurance costs, that actual change, that actual downward, that pressure to insure greater value properties on a greater breadth of this country, there's really no place in this country that is safe from the insurance effect cost. And so when you start to look at PITI, P-I-T-I, you got to consider the whole number now. And this, my friends, this could spell the first break, the first catastrophe that we start to see rising in distress for residential and commercial real estate. I know it exists right now already. I have friends in multifamily who have gross leases. They're seeing their tenants wanting to pay less rent. not able to afford. Rents are no longer going up in rental markets. And many of the landlords of multifamily or single family properties, when they figure out if their tenants are qualified, they just give them a gross number. So if the taxes and insurance increase on your investment property, but the tenants pay the same amount of rent, in essence, you're getting a decline in your net operating income. And net operating income on commercial real estate is the whole kit and caboodle. It's something like we haven't seen ever before, where TI is now the conversation, not just PI. And PI, well, that's had its effects too. It's like a perfect storm. PI is being affected because interest rates are not where they were 4 years ago. We saw a dramatic increase in interest rates as inflation spiked in the middle of COVID 3 years ago. We saw a change in monetary policy. So now all of these forces are coming together. You've got a rise in interest rates, the I in PITI. You've got a rise in taxes because properties, especially investment properties that are not subject to the protection of homestead, those investment properties are subject to annual assessment increases by local and state governments. They increase the property value, your property value, on an assessed basis, while maybe the actual value of your property has gone down because the income is going down. So now you've got taxes increasing, you've got the interest that is increasing, and you've got insurance costs, if you can get insurance at all. And obviously in the commercial market, many retail landlords, many commercial office landlords, industrial, they will rent their buildings based on double net, triple net leases. Those are where they give a fixed income net on the square footage, and then the variable costs of taxes, insurance, common area get passed through and recalculated on a yearly basis. But even those folks are having problems with PITI, because if the tenants are having to pay more in common area maintenance, in taxes, and in insurance, and the landlord still wants the same net rent, that means the tenants' costs have gone up as well. The profit margins for tenants has gone up. We will see more bankruptcies of lessees, just like we'll see more distress of landlords and single-family investment operators and multifamily investment operators and commercial landlords. We're going to see it all. And let's even talk about owner-occupied. Listen, PITI affects you too. It is quite a pity, because I remember Dad talking about PITI. That's how we calculate if your affordability is there. And did you know that in many cases, the more liberal government-backed conventional mortgages, when they calculate PITI and how much you can afford on a monthly basis, they'll cover you up to 50-60%. Over 50% of your income on a gross basis, pre-tax, could be allocated towards the PITI payment. Well, that was fine and dandy when interest rates were 2%, 3%, 4%. But if you were in a commercial loan that was a 4% multifamily loan 5-6 years ago that you originated, though, even if your commercial loan is amortizing at 15 to 20 years on the payment, most commercial mortgages have a balloon situation, which they call a maturity date. Because even if you have a commercial loan that's based on a 20 or a 30 or a 40-year amortization as far as principal and interest are concerned, the commercial loan market works on much shorter periods, 5, 7, 10-year balloons. So folks that got 4 or 5% mortgages back in 2018, 2019, 2020, where rents were on the increase, taxes were maybe not adjusted, maybe we hadn't seen the kind of huge spikes in insurance that we've seen post-COVID since this huge influx and uptick in in large weather events on a nationwide basis. So now you're a multifamily operator. I know many of them. You could be a doctor, you could be a lawyer. You've graduated from single family to a 12 unit. You got this 5% mortgage 6, 7 years ago. Guess what? The bank's calling. Maybe your DSCR, your debt service coverage, which is another way of calculating the PITI against the income in the property or your income as the borrower of your home. So debt service coverage ratio is also how they look at, the calculation. It's another way of looking at it on a commercial basis. Well, all of a sudden now, look at these mortgages that you got where you really increased the volume and the principal balance because the interest rate was low. You wanted to borrow as much money as you could back in 2018, 2019, 2020. And interest rates were low back then. So maybe you got yourself a 4.5% interest rate at a 1.25, 1.3 DSCR. Well, if you were on a floating rate, like many adjustable rate mortgages that were created back in the day, then you may have already seen those increases from 4% to 6% to 7%. Do you know if you were the borrower on a commercial property with a 1.2 DSCR ratio, which means that the income on your property at the time of origination, let's say 5, 6 years ago, you got this loan and your debt service coverage ratio was 1.2, meaning you had a 120% of what your expected payment was coming in the way of rental income from a property, commercial, residential, whatever it might be. Now, if you move those interest rates 2%, adjustable rate mortgage, maybe in 2022, your ARM went up to 5. Maybe by 2023, now that rate is 7 or 6.5. A 2% move in your rate on your mortgage alone, if you had a 1.2 debt service coverage ratio and all other things equal, not taxes increasing, not insurance increasing, and not income declining, not rents going down, no tenants leaving the building, just the interest rate alone will turn that DSCR into a negative, meaning you go to a 0.9. Or a 0.85, which means you're literally, as an owner of the property or a landlord, you are net negative on a monthly basis, coming out of pocket to pay the principal, interest, taxes, and insurance payments that are necessary to keep your mortgage paid. I mean, it was a great program when I grew up, figuring out PITI, figuring out debt service coverage ratios, figuring out whether you could afford to buy a home. And it was a lot easier calculation when principal and interest were pretty much the main factors. For the longest period of time in this country, taxes were pretty much a steady figure. Even if you saw a 5 or a 7% annual increase in the value of real estate, those were not translating. Cities and states weren't increasing regularly the assessed values of real estate. And what we saw in the last 4 to 5 years, because of the end of the long era of cheap money and the big rush to move into real estate, taking government given funds from PPP, investing into new real estate, second homes, third homes, investment properties. That just created 15-20% increases in some markets. So now you had this runaway valuation driving up the value of properties, driving up the assessed value of those properties. By the way, that has a direct impact on the insurance, because the insurer is not only looking at the facts that there are more weather-related events today than there were before, that the predictions that all points lead to an increased volatility in climate on a nationwide basis that there will be more tornado events, that there will be more lightning events, that there will be more mudslides, that there will be more major rain events. We'll have hurricanes hitting the Northeast or the middle of the country. We'll have major wildfires all over the West. We've seen that for years. Now we're even starting to see that in the Northeast. We're seeing fires in places like Prospect Park, Brooklyn, that are burning down entire swaths of the city's largest natural park. We're seeing fires in New Jersey, and this is not going to stop. And this is not a conversation about the cause. It's a conversation about the fact. So now you've got insurance companies looking at the increased probability of weather effects and the cost to insure real estate and the liability costs, etc. But they're also pegging that against a real estate market that has doubled and tripled in value in some regards, especially in the residential side, where you've seen a bubbling of the equity, what was the paper value of residential real estate, up into the 30 trillion mark, something you've never seen before. So now, all those things being equal, those costs are coming back to us, the consumer, the borrowers. Oh, what a pity it is. PITI, folks. That's the conversation to keep in mind when you look at why is there distress. You've got residential homeowners who maybe are on a fixed rate. By the way, PITI affects even folks on a 30-year fixed mortgage. I've got friends in Florida who live in condos or live in single-family homes near the water, and they're on fixed incomes. Maybe they only owe $200,000 on their $500,000 house near the water or $1 million house. And maybe the assessment hasn't gone up tremendously. Maybe their taxes because of homestead are only $4,000 or $5,000, $6,000 a year on a $500,000 house. They'd be lucky if that's the case. More likely, their taxes are closer to $10,000 because Florida, on average, has about a 2.25 millage, meaning about just over 2% of the property value is what the state of Florida will usually tax owner occupants or any kind of real estate owner. So imagine you're a fixed income homeowner, you're in your 50s, you retired to Florida, you bought that house, you got this amazing 30-year fixed mortgage 7 years ago at 3.5%. Okay, and you owe $200,000 on it. So your payments are roughly nothing. In those cases, you might own a $600,000 house. Your payments are $1,000 a month on the principal and interest portion, the PI of PITI. Now, imagine where the market has gone. You've seen some increase in your taxes. Maybe it's not so bad because it's your homestead. But in that case, where your principal and interest payment might be $1,000 a month, you might have $500, $600, $700, $800 a month in TI. And relatively, historically, taxes and insurance have been a smaller, more stable number, but that is not the case anymore in Florida. In Florida, people are getting dropped completely, and if they have to get insurance through the citizens policy, the insurer of last resort, who are by all means a less quality insurer, and folks are having to pay double, triple in insurance costs. I can name 3 people for you right now where the principal and interest payment of PITI is no longer the largest portion. So whereas historically you might have had a $1,500 a month PI payment, principal and interest payment, and even if that's fixed over 30 years, that's great. Taxes and insurance are not fixed. I know people whose taxes and insurance payments are higher now than their principal and interest. Oh, what a pity that is. And that's where you're going to start to see distress even for those folks who have been in their homes nationwide for years, even if they have an amazing fixed interest rate mortgage, if you're on Social Security and you were looking at $1,000, $1,200 principal and interest payment, and a $500-$600 taxes and insurance payment, now that insurance has doubled. Maybe the taxes have gone up. So now all of a sudden, that $1,200 PI is also facing a $1,200 TI. And most people I know on Social Security don't make more than a couple $1,000s a month. Do the math in your head. You can see how they might have gotten qualified for PITI when it was a total of $1,500 or $1,800. But the TI has now doubled, and that $1,800 gross payment is $2,400, and maybe the Social Security is $2,800. How this is being affected, I know person after person, and I'm not just talking Florida, I'm talking Houston, Texas, I'm talking Los Angeles, California, I'm talking Boise, Idaho, because of the increase in property values. I'm talking the Northeast, where they're seeing weather events they never imagined seeing 10, 15 years ago. This is affecting all of us. It's affecting single family homeowners, those on a fixed income and a fixed mortgage. It's affecting single family rental homeowners, whether you're institutional or a private investor, you know what I mean. And certainly the realization of this is affecting commercial real estate on a broad basis. It's a perfect storm, to be honest, because you've got now a leveling off in the ability of tenants to raise rents and pay more income. We've got a cooling off economy that most economists are predicting on the verge of a recession. 90%, as I heard first thing here at the end of April 2025, major predictions coming out about 90% chance of recession. You've got an increase on taxes. You've got an increase in insurance. You've got a defunct situation where a lot of folks are stuck in these fixed interest rates. It's really affecting all of us. And if you're a banker and a lender looking at a portfolio and you're scratching your head saying, I don't understand why these borrowers are defaulting. They've got 40 LTV loans. Well, if they can't afford the payment, because even if the equity is there in your home, it's on paper until you sell it. You know, I've said it before and I'll say it again. We've gone from undersupplied markets to a glut in very short order, in 12, 18-month periods. We saw that happen from 2007 till the 2009 near the bottom, where all of a sudden inventory levels shot up into the double digits, and we saw double-digit declines in real estate. Now, history doesn't repeat itself, but it certainly rhymes. We saw it in equity market bubbles. We've seen it in real estate, both in 2008 and in the late 80s, early 90s, with the savings and loan crisis. Get your popcorn ready. It's a pity, but pity is going to have its effect on real estate and real estate debt. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.